Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. In a White House meeting today, the U.S. president said that NATO was making a foolish mistake by not helping the U.S. escort tankers in the Strait of Hormuz. It comes after yesterday's press conference where Donald Trump expresses frustration with allies and other economies who have been non-committal to his calls for help.
NATO's making a very foolish mistake, and I've long said that, I wonder whether or not NATO would ever be there for us. So this was a great test, because we don't need them, but they should have been there.
Based Atkins Realis is collaborating with NVIDIA to integrate NVIDIA's technologies into the development of nuclear-powered AI factories. Atkins Realis says the technologies could help provide a framework to design digital versions of the infrastructure before building it in the real world. The Bank of Montreal plans to open more than 130 financial centers in California and about 15 in Arizona over the next 5 years. The bank's looking to expand its presence in the U.S. West after the sale of several branches across the nation last year. The lender says the expansion will create hundreds of jobs and enhance access to in-person and advice-led banking. MasterCard buying stablecoin payment infrastructure firm BVNK for up to $1.8 billion U.S. The London-based platform enables sending and receiving payments on all major blockchain networks across more than 130 countries. MasterCard says it expects most financial institutions will eventually provide digital currency services. The transaction expected to close before the end of the year. Markets continue to bounce back today. The TSX Composite was up several hundred points earlier in the day, but now up only 37 points to 32,913. In the U.S., the S&P is up 0.33%. The Dow Jones moving up 77 points, or 0.2%. The Nasdaq up about 0.5%, 107-point move up so far on the day. So markets staying positive even as oil prices head higher amid the lack of signals pointing to an early resolution of the war in Iran. For more on how to invest in what is a volatile environment, let's go to Diana Avigdor, Portfolio Manager, Head of Trading at Barometer Capital Management. Diana, are you buying on the dip with the pressure on the market, or how are you managing this volatility?
It's a great question. I think it's pretty consensus that we believe that the length of the conflict is not the issue. The issue is transportation through the Strait of Hormuz. So if we were to be able to let trade happen, that would relieve pressure on oil prices and other commodities like fertilizer. And so the big question is, at what point does it become growth impact on growth, initially inflationary, but then at some point it stops being inflationary and it impacts growth. So the way we manage the portfolios is we focus on risk management. We monitor positions against support levels that we deem are important. And if they break it, we exit and we avoid reinvesting those funds. So we're running a highly elevated cash situation in a lot of our portfolios.
Okay, for energy stocks specifically, do you own them? What are you doing with them right now?
Yeah, so we've been in energy before the conflict. Particularly the Canadian energy stocks have acted really well even before the Iran conflict, and now they're acting even better. And we've been invested for a little while in several of the major large cap oil companies in Canada, and we continue holding them. We really didn't have to add as we had a full position in them. So those continue to work and obviously are not breaking any support levels at this point.
You mentioned you're keeping an eye on how this disruption could affect the North American economies, the U.S. and Canada. How long would this have to continue before you feel you have greater concerns about growth?
Well, that's a great question. So I think that initially, where we're going to see the weakness is in earnings. As companies are coming into the situation with really high margins, high operating margins, and good cash flows, economy and the earnings seasons, several quarters now, we've seen companies firing on all cylinders, which, by the way, why energy was working before that. And it's a very underinvested sector, especially globally. So that was in play before then too. So when we're going to start seeing the impact on earnings, so that'll be a little while. Say this conflict continues and oil stays elevated until the next earnings season, and then you'll start seeing it in the margins as companies are not immediately going to pass the costs on to the consumers, and oil goes into everything almost. You'll start seeing impact on margins.
Both the U.S.
before
Fed,
you see it in the CPI.
Both the U.S. Fed and the Bank of Canada announce rate decisions tomorrow. Do you think they're worried about potential stagflation? Do you think that'll be in the commentary?
Maybe. Certainly could be a good hedge. I know that, we all know that in the U.S. there is a big pressure for the central bank to lower rates, and this situation complicates that. So it's possible that it's mentioned. Certainly, I think that central bankers are just like all of us, really. I don't think they know anymore. So from a hedging perspective, could possibly mention that this could be inflationary and be on the wait and see attitude. I don't think any of them do anything to rates this time around.
Let's talk about stocks where you would invest today. You mentioned you're holding a lot of cash right now. You're watching support levels for some stocks. If investors do want to put some new money in, what sectors do you point them to?
So the safest thing right now would be energy, and not just if the war continues. If oil was to retreat, you might have a little bit of a check back, but these stocks are in an upswing since, basically 2020. If you look at some large cap energy charts, Canadian energy charts like, Suncor, CNQ, or Imperial Oil. So you can put some money to work in that sector. If you had any new money, I wouldn't be worried too much about that.
Okay. One of them that you do like right now is Canadian Natural Resources, which was flat for much of last year before you mentioned benefiting not only from the recent conflict, but starting to go up at the start of the year. Would you put new money in to CNQ today?
Yeah, I would. I think that the market is trading two stories. One is the war continuing, and the other one is not. But if it's not, then we can continue focusing on economic growth that we've had before, and the risk is out of the market. And I think this is a company that's a best-in-class, low-cost producer, really strong free cash flow, has grown dividends. If you're an income investor, it has a 3.7% dividend yield right now, has grown dividends 22% over the last 5 years, and consistently generates good free cash flow that's returning to investors. Really paying down debt and opportunistic share buybacks during the period. So I think investors will be well compensated for holding the stock.
All right, Diana, I'm going to leave it there. Appreciate your time on this. Diana Avigdor is a portfolio manager, head of trading, Barometer Capital Management. Coming up next, NVIDIA shares are down, even though the CEO, Jensen Huang, projects $1 trillion worth of orders for the company's advanced chips. Back in a moment. At NVIDIA's annual developer conference, the CEO, Jensen Huang, projected $1 trillion in orders for Blackwell and Vera Rubin systems through the end of 2027. And also, it reaffirms NVIDIA's leadership in that chip market. But the stock remains volatile. It's down year to date. So let's go to Gil Luria, head of technology research at D.A. Davidson. Gil, let's talk about the fact that almost nothing, no matter how good the news, no matter how strong the earnings, this is a company that is range bound and has been for a while. Tell me what you think is continuing to weigh on NVIDIA.
I think investors just don't believe that CapEx from the hyperscalers can keep going up next year. That they think that the investment in AI will peak this year, and therefore NVIDIA's results can't possibly go up from here. And in spite of the fact that Jensen Huang, to your point, just said, no, actually next year will be considerably bigger than this year, probably a 30 to 40% growth off of this year. And investors are just not willing to believe that. You can tell that from NVIDIA's valuation, from other chip companies' valuation, and from how the hyperscalers themselves are trading at, from Microsoft, from Meta, for NVIDIA, they're trading at market multiples, which tells you, in spite of their very high growth rates, that tells you investors just don't believe the investment will carry into next year.
Okay, so it sounds like investors have just moved on and don't want to look back. NVIDIA is known for its GPUs. What steps is the company taking to expand into the CPU market?
Yeah, so it's expanded well beyond the GPU now. If that was the focus up until now, they are talking a lot more about networking components, about software, and about expanding significantly their production of CPUs, including CPUs that go into CPU-only data centers, the ones that don't even have GPUs. That is a new market for NVIDIA and a pretty big threat to AMD and Intel.
Do you think that NVIDIA can catch up to either AMD or Intel?
Well, in most markets, NVIDIA's run circles around all of their competitors, so that is a bigger concern. Now, it's not NVIDIA's focus. It's something they're doing really as an extension of the fact that they're making a lot more CPUs to go into their GPU data centers. And since they're already making CPUs on a standalone basis, they decide, well, that's fine. We're willing to sell those into standalone CPU data centers because a lot of AI is actually going to start happening on a CPU. So agents are going to execute tasks that don't have to happen on a GPU. They can happen more efficiently on a CPU, which is why NVIDIA is extending into those markets. And again, that is a significant question for the incumbents there, which is especially Intel and AMD.
All right. We also heard about the Grok 3 language processing unit NVIDIA is working on. What will that be used for?
So the market for AI compute is transitioning very rapidly from pre-training, post-training, and into inference. Inference eventually will become most of what the AI compute that we need. And for that, you need a different type of compute. And for NVIDIA to maintain and extend its lead over competitive products, mostly from Broadcom and AMD, it needed to find a new solution that could help them get higher throughput of tokens, higher throughput of calculations per unit of energy. And that's what the Grok chips do for them, these LPU chips. So they can use their existing system and build out around GPUs. And by adding these LPUs, the Grok product, they can significantly increase the inference throughput, thus extending their lead over solutions from AMD and Broadcom.
Okay, so instead of building that into the architecture, it's more of an add-on.
That's right.
Okay. There's also a driving partnership now announced. So this was a heavy new announcement sort of conference going on. NVIDIA is going to work with Nissan, China's BYD, which does EVs, and Hyundai, for example. Do you expect the company to in any way compete against companies like Waymo? Is that the direction they're going?
Well, they want to mostly make it possible for any car company to participate in self-driving. Tesla has its own proprietary technology. Google's Waymo has its own technology. And so they want to make sure that any other car company that wants to have self-driving as a feature in its cars can have that. Whether those car companies decide to participate in a network or a marketplace like an Uber or a Lyft or a Waymo, that's up to the car company, but at least the car company can provide its current customers the ability to do self-driving. And BYD is a very significant partnership. That is the largest EV company in the world now.
Yeah. Anything else strike you from the conference? And I'm wondering, with a series of announcements like they had today, again, do you see some more growth for the stock ahead, given how many different hands they have and how many different projects right now?
I think the growth in the stock really depends on us getting close to next year and investors believing that the growth will continue into next year. We're going to get 3 months from now. Microsoft will talk about their next 12 months. So we'll start getting a glimpse into 2027. And as long as that glimpse tells us that more data center construction is going to happen next year than this year, that should be what helps NVIDIA's stock the most. After that, we'll hear from Google, from Amazon, from Meta. So as we get closer to 2027, investors will start believing Jensen Huang more about his guidance that he can do $1 trillion of Blackwell and Rubin.
All right. Gil Luria is head of technology research at D.A. Davidson. Thanks for your time. Appreciate it.
Thank you.
Coming up, a new poll from RBC shows despite the market uncertainty, Canadians still want to own a home. More in a moment. A new poll from RBC says 2/3 of Canadians still dream of owning a home, but many are still hesitant about making the leap. For more insight, we sat down with Janet Boyle, Senior Vice President of Home Equity Finance at RBC.
The spring market is upon us. And I think what our poll shows is that Canadians have not given up on the dream of home ownership. I think they're just being a little more mindful and approaching it in a cautious fashion. So our results indicate that almost 67% still feel that buying a home is well part of their future dreams. And that's actually up from last year. So I think that kind of increase in confidence and expectancy, I think, from the home buying population is really, really encouraging as we enter into the spring market in what has been a pretty kind of challenging set of headlines coming out of real estate.
I was going to say that, and just challenging in general. I mean, we have the questions on the concerns about the economy, concerns about mortgage rates, what's going on in the world right now. Do people say what gives them that optimism? And do you know why more people think they'll be able to own a home?
I think what's changed, Roger, is just really their mindset, right? They've moved from this fear of missing out and having to rush in to really taking a thoughtful and measured approach around when the time is right, making sure that they are savings. We saw a really strong response in terms of the amount of savings that first-time homebuyers are putting aside. And they still feel that it's part of kind of demonstrating that financial responsibility or financial independence. We saw that almost 73% felt that owning a home demonstrates a strong amount of financial independence. And so I think that continues to go along with this narrative of saying, I'm ready to enter the market. I want to do so with the right advice at the right time and putting together the right amount of savings. So I think there's a lot of these levers that are coming together to support that level of home buyer confidence.
And the young people, I mean, we've talked about the younger generation, the Gen Z's just saying we're never going to own a house. Do they have optimism about this? Yes, they think they actually they might be able to buy a house.
Like those first-time home buyers, our numbers were showing 62% actually feel that they are closer to their dream of owning a home today. And I think that's a really strong number that suggests a high degree of confidence in terms of their ability to enter the market. So I think in spite of some of the other headlines that we've heard, we are continuing to see prices moderate. I'm not looking into the crystal ball, but certainly lots of experts that you've had on the show suggest no rate increase or decrease by the Bank of Canada upcoming. And so this continues to suggest that for those who are ready to make their first home purchase, it is a good time to be thinking about a spring purchase in this market.
And we've talked about, and I mean, the numbers just came out today. Sales were down, average price is down for a home. I mean, for some people, that's bad news, but for other people who are looking for a house, that's good news, isn't it?
It is. And I think even if you look at a next-time home buyer, what you'll see is 75% of people from our poll indicated that they felt that owning a home was still a very, very good investment. So very, very strong sentiment from those who are current homeowners. And of course, we know that next-time home buyers also make up an important part of the spring market. So not just first-time home buyers will be out there this year. We also think that there'll be a number of next-time home buyers that are looking for a new property, either in terms of expanding or other types of lifestyle changes. So I think that's the other factor in play, that those buyers continue to feel that their home has been a very good and solid part of their investment strategy.
And I mean, we're also seeing the provinces looking into this. We're hearing from Ontario that they may drop the HST on new homes, which is another incentive that may draw more people in.
Yeah, I think there's no shortage, I think, of options in terms of different experts weighing in on what we need to do to support, a more robust home ownership strategy. I think certainly that support of various levels of government around taxation and levies and things like that always goes a long way in terms of contributing to just making that affordability more within reach for more people.
And now you talk to people who want to buy, but also people who have homes already, and mortgage renewals are front and center for them.
Yes. So I think when people are thinking about renewals, they want to make sure that they're getting good advice, strong strategies around do they want to go fixed or variable. And I think what we're seeing is a lot of great opportunities for certainly banks like RBC to be reaching out to clients with a very strong set of advice tools around what they want to be thinking about as that renewal comes up, and being very proactive and investing the time and having a really rich and fulsome conversation around what their options are and what's the best opportunity, product, and program for them to enter into as they're thinking about that mortgage renewal.
Janet Boyle is Senior Vice President of Home Equity Finance at RBC. A last look at the markets before the end of the trading day. The TSX Composite had been up several hundred points start of the day. That's dropped down to just a 36-point lead today. So 32,921 is where we stand, just under the 33,000 threshold. South of the border, much of the same here. Not a big move for the S&P today. It's up 0.25%. The Dow Jones up even less than that, and the Nasdaq 101 or 100-point move up on the day, about 0.5%. A quick look at oil, which we've been talking about, of course, for the last several weeks, and West Texas Intermediate sitting right now at 96.13. So the closing bells on Bay Street and Wall Street when we come back. Here are the closing bells for the end of the trading day. At the Nasdaq, Ava Technologies ringing the bell. In New York, Diageo ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. No real momentum for the markets to end the day. The TSX Composite up just 52 points, or about 0.2%. Not a material move for the S&P 500, and the Nasdaq about 0.5% up today, 105 points by end of day. Let's get to the movers in Toronto. Go Easy having a bounce back day, up today 13%, or $4.44 a share. After crashing out recently after suspending its dividend. Lots more going on there. And Stephanie Hughes will update us in just a moment. NFI Group is up today more than 5%, closer to 6%. And then ATS also moving up on the day. It gained 6%, or $2.45 a share, to $42 flat. G Mining Ventures down today 6.4%, a loss of $3.12 per share. And then Oceana Gold is down as well. It's down over 5%, taking the share price to $45.56. All right, let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now. Stephanie, there was a short seller report on Go Easy last fall that triggered a cascade of events. You spoke to the person behind that report. What did you learn?
Yeah, that's right, Marilla. Yeah, it was a really interesting conversation. I spoke with the Jehoshaphat short seller researcher named Victor Bonilla, and he really took on a more optimistic and forgiving tone when it came to Go Easy than certainly I was expecting heading into the conversation. So a few months ago when he first released the short seller report, he ended up being validated when the company did announce that it did have some delinquencies and net charge-offs that I was expecting. So I guess I was expecting more of I told you so or a victory lap moment. But actually his biggest takeaway was that the company had essentially come clean on these loan delinquencies in its loan book and just the amount of charge-offs it's expecting in the fourth quarter that it will be reporting next week. So quick recap for viewers. Jehoshaphat Research said last September that Go Easy was essentially sitting on $300 million in improperly delayed credit losses that had been buried in the balance sheet. At the time, Go Easy dismissed the report or said it was misleading, and analysts were pretty dismissive as well. But fast forward to last week, Go Easy, the subprime lender, ended up announcing that it's expecting a total of $331 million in net charge-offs for the fourth quarter. They added that they were going to revise past disclosures in their auto lending business, LendCare, and confirm that Felix Wu will be the permanent CFO on an ongoing basis. He had been the interim CEO over the past, over the past few months. So this was actually, all of this was a pretty refreshing change of pace for Bonilla. He was optimistic he views these steps as a way for the company to refresh its strategy and actually reestablish credibility with the markets. So the company may have a lot more work ahead of it. You can see that chart there. It's had a pretty precipitous drop. And as of the article's reporting or released this morning, the shares had dropped by over 80% since that short seller report first came out in September. So nevertheless, the short seller still has an optimistic view of the path ahead, Marella.
All right. They have a big hill to climb back up to. What happens next with Go Easy? You mentioned, for example, they report next week.
Yeah, so the next big thing is for sure when the company reports its fourth quarter results after the bell next Wednesday, not this Wednesday coming up, but next Wednesday. And basically we're all looking for the tone that the executive management team takes at the time. So we won't get that until Thursday morning when the conference call takes place. So ideally that should provide more details on how the company will get things back on track, maybe more details around that 6-point plan that it kind of hinted at during its announcement last week. Maybe more focusing on the direct lending business and getting some distance away from the auto and power sports business, which had been facing a bit more pressure lately. It's an industry-wide thing, I'm told. And for Victor Bonilla, he said that he'd be very surprised if there was another shoe to drop. It seems like the reckoning might be done and dusted, but remains to be seen. We'll have to keep an eye out on that. But don't confuse his optimism for bullishness. He's not taking a long position in the company, and he said that the company would need a complete re-underwriting for it to be even considered worth buying in the weeks ahead. So he also wants to make it clear that he's not against Go Easy. He's not against the subprime lending industry. And he hopes Go Easy survives, given that he said that there's not a lot of options for people who need that level of credit to access. So we'll have to see what ends up happening next week, but it was a really interesting conversation, Marilla.
Yeah, and definitely a storyline that sent out a lot of tremors across the industry. Bloomberg's Stephanie Hughes with that update. Thanks for that. Let's get to some movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz is there. Bailey, we've been talking about NVIDIA today. They're partnering on autonomous vehicles. So who got the bounce from that news?
Yeah, seeing a rally today in Uber and Lyft, the two companies that, at least according to bearish investors, had been at risk of missing out on autonomous vehicles, just given the partnerships and rollout that we've seen from the likes of Waymo and Tesla. So we did see a pretty sharp rally, all things considered, for both Uber and Lyft. Not a eye-popping gain, as you can see. Little more than 4% for Uber, and closer to 3.5% for Lyft. But the big questions being addressed, according to analysts, has been the longer-term picture of autonomous vehicles and what that could mean for these ride-sharing companies. And it seems like, at least in the interim, the partnership with NVIDIA to enable and roll out fleets in the coming years, at least temporarily addresses some of that uncertainty.
Okay, let's get to Delta. They shared an update today. They included how hard it is getting hit by the higher fuel prices that they have seen. What else did the company say?
They were more optimistic, though. There's uncertainty, obviously, around what the ultimate knock-on effect of higher oil prices are for Delta and other airlines. But when you look at what they laid out today, strong forecast for sales for the first quarter, strong passenger growth. It does seem like even with higher ticket prices, consumers are still lining up and looking to take advantage of some of the flights that they are offering, which does kind of address, again, at least the more bearish sentiment that we had been keeping track of. The thing that also stood out to me today was the fact that Delta and a number of other airlines were outperforming today on a day that oil was in the green. So no longer at least a pair trade where kind of going the opposite of where oil is going. And it does seem like, at least looking through the initial analyst reactions, a bit more optimism on Delta, not only for Q1, but also looking further out.
All right, what's going on with Zillow? Because that is a name that I haven't heard in some time.
Yeah, Zillow up today after announcing they're unveiling something called Zillow Preview, which essentially would give users access to listings or homes that aren't actually listed just yet. As you can see, still nowhere near where it was trading over the summer. And if you step back further out, it's even sharper of losses. But we did see a rally today, just given the optimism that this could look to kind of bolster their data, bolster their ability to right-size pricing. That's what analysts did call out. Again, a solid gain today, nowhere near where we had been, and a lot of wood to chop in terms of getting back on investors' good side. But the initial reaction from analysts on Wall Street was that this is a step to not only upsize pricing, but also help with some of their data providing. So it does certainly seem like a step in the right direction with that Zillow preview. I don't know about you, but I spent a lot of time, even though I'm not actively house hunting, scrolling through the website and some of the listings. So definitely going to be interested to see as an end user what that looks like.
Yeah, it's just a curiosity, I think, wanting to go through people's homes, even though you're not planning on buying a home. I get what you mean. Bloomberg's Bailey Lipschitz, thanks for the update. Coming up next, Lululemon reporting fourth quarter earnings. Those are coming into the newsroom right now. We'll have those numbers when we come back. We have fourth quarter results coming into the newsroom right now from Lululemon, a company that is closely watched by many. Here is what it looks like after hours right now. Stock at 155.83, so it's dropping in after hours trading. Earnings per share for fourth quarter coming in at $5.01. The estimate had been $4.78 by Bloomberg, so that is a beat on earnings per share. Net revenue coming in at $3.64 billion. The estimate had been $3.58, so they did beat on net revenue. America's comparable sales down 2%. The estimate had been down more than that, 4.09%. And international comparable sales are up 16%. The estimate had been up 11.4%, so they beat in sales internationally. Inventory at $1.7 billion. Estimate had been 1.65, and total location count at 811. Also, news from the company that former Levi Strauss CEO Chip Bergh will join the board for Lululemon. Here's the forecast for the company. They're seeing forward net revenue at $11.35 billion to $11.5. Now, the estimate had been at that higher end of 11.5, so almost a bit of a warning from Lululemon here. And they're seeing forward-looking earnings per share at $12.10 to $12.30. The estimate had been much higher than that at $12.59. So let's take some of this and go through it with Jessica Ramirez. She's co-founder and managing director at the Consumer Collective. Jessica, this is a company under scrutiny, as you know, by investors. They're looking for the turnaround. Any sign of that in the latest results?
Well, the U.S. is still down. North America still had figures decrease. So I think that's, a continuation of what we've seen in terms of difficulty. I think from what we see in general with the stores, there's some newness, but I don't think there's enough. I think, especially as we're on the hunt for a new CEO, I think the product team is also something that has continued to have some misses. And again, they've lagged before, which I've stated previously. So I think it's a bit of a long way and also a tough macro environment and a very competitive landscape overall.
Okay. You mentioned that product lineup has been a drag on the company. One of the big parts of that is their women's category. Do you see them trying to address that in any obvious way?
You know, they used to be very good about having a miss and picking up really quickly. I haven't seen that in the past year and a half, I would say, almost two. So I think that's where we've seen the most difficulty. And at the same time, as I said, you know, the competitive landscape, and I'm not speaking necessarily of just Alo or Miori, but if I think of Nike, if I think of Adidas, if I think of On, you know, really flexing that apparel arm and really focusing on women, it's pretty impressive. And I think, again, if you're having a lag in product and someone else is really picking up that market, which, again, there's so much going on in sports, so much in athleticism in general, these other companies are looking to take back some share or gain share.
You mentioned the weakness in its U.S. market in particular. Lulu does plan to go into new markets, including Hungary, Greece, Austria, and India this year. How much can that expansion help? India obviously is a big market, but is there a big market for this kind of product, or does it need to regain its U.S. ground to really survive and do well?
Well, the majority of the business is made up by the US. It is a very large market, so you cannot necessarily take the fault very easily and put that onto runway growth, which, again, there is a lot of growth outside of the US. There's a lot of new markets. And I do believe that the sportswear and the active lifestyle is actually a global movement. We do see they do it great in China. EMEA does well for them, and again, opening much more markets. I think that there's a lot of interest in India, not only from Lululemon, but from many other companies. So that is an emerging market to definitely be part of, especially in early days. Again, I think you just cannot necessarily falter in a market that's as big as what they account for their business here.
It needs a CEO. Are there any obvious candidates being vetted at this point?
I feel like there's been rumor for some. I would necessarily like to see one that comes strong from product. It is previously where we saw the height of Lululemon was when we did have McDonald and also Sun, who recently left again to go over to Vans. But those two really did a great time together for the company. Obviously, the company grew massively under McDonald, and that really being strategy and strong in products. And you kind of really need the two for a company this big and to continue to grow at the momentum that it did. I think like I said, I do think someone who has the strength in product would be ideal. I'm interested to hear the news of Chip joining the board. Chip did a great tenure at Levi. And again, he's a person who understands products, so I'd be interested to know what further advancements he could bring on or who from his network he could bring on over to Lulu.
Okay, let's get to Chip Wilson, founder who's highly critical of the company very publicly quite a bit. How much is that damaging the company, both financially and for its image?
Yeah, I think that it's a lot of noise that Lululemon probably doesn't need right now. And, you know, there's a lot going on. And I think, especially for the company internally, there's likely to be doubt of what's happening. And again, up in a time with internal jobs, you know, being questioned, I think that that's something that becomes a little bit more, gives more uncertainty within the company. And why I mention that is when you have a creative department that is essentially having faults, that team definitely is one that needs to be increased and given that security or giving guidance under the right person. And I think outside noise like this is disruptive to a company, especially when it's trying to go through a turnaround.
All right. So if you are looking for catalysts from this company for the year, what would they be?
Definitely looking to get into the right categories of where the consumer is going with activewear. Where also you're faltering in terms of the competitive landscape overall. I think that's really where I would be watching where they start moving first. You know, again, they do have some wins. I think they've done great with ambassadors and bringing new talent over. They have done well with tennis. They have done well with running. Tennis, I think, is still a category that not necessarily everyone has gone into. And that's still a huge opportunity, especially for racket sports in general. So again, just watching closely on all of those fronts.
Yeah, they need to get into pickleball. All right. Jessica Ramirez, yes. Co-founder and managing director at the Consumer Collective. Thanks for your time.
Great. Thank you.
Coming up next, the markets are in wait-and-see mode for the U.S. Fed rate decision, which comes tomorrow. Of course, volatility by the Iran war to be considered here. We're back in a moment with more on that. With the U.S. Federal Reserve set to announce a rate decision tomorrow, let's get some insights into consumer spending and the U.S. job market and how that feeds into any discussion. Meredith Whitney, who became famous as the Oracle of Wall Street for predicting the 2008 financial crisis, joins us now. She's CEO of Meredith Whitney Advisory Group. Thanks for your time.
Thank you for having me.
So let's start with the Fed. Widely expected to hold rates tomorrow, but oil's at $95 a barrel, roughly, and there's that weak jobs report from last month. Could they start to worry about stagflation, you think, in the U.S.?
I think they're going to be worried about everything, but I don't think they're going to do anything. They're going to be data dependent, and they're going to wait for more information. So the employment report had a lot of one-offs, and so I think they're going to wait for another employment report. Clearly, there's inflation in the market, right? There's labor inflation, there's commodity inflation, there's food inflation. February spending numbers from Spend Trend just came out, and I think you could read a lot of inflation into the month of February, even before the war started on February 28th. So they're going to be dealing with a lot of different variables. I mean, the job market is not falling off a cliff. It's just, I think that there was a lot of front-end loading, front-end hiring after COVID, and that's subsided.
Okay, so the U.S. economy, as we know, is driven by consumer spending. You mentioned the price of fuel, which is spiking. That's taking money out of people's everyday budgets. Are you worried about slowing GDP growth at this point?
Well, the sad reality is that the people who are most affected by higher gas prices, higher food prices, the bottom 60% of households only drive about a third of consumer spending. So the top 40% of households have seen no real problem in terms of slowdown in spending. They've got ample liquidity. They've got plenty of access to credit, and they haven't slowed down in spending. So if you look at the areas where they're spending a lot on, Delta said that travel is up. They're spending a lot on travel. Actually, travel was the highest spend month in February that it's been since June 23, when everyone had the revenge travel, the COVID travel, FOMO, YOLO travel. And so you're seeing the discretionary spending areas be strong. Well, that's been driven by the high end. The folks that are living paycheck to paycheck are struggling, and I would argue they're barely living paycheck to paycheck. So, because they don't drive overall spending more than a third of total, I think that the economy actually is going to be okay.
Okay, factor in for me AI, because we know the big tech companies are into massive layoffs, and we're seeing some of that play out last year. That's continuing to play out this year. Is that a concern for you moving forward? You said you're not that concerned about the labor front just yet. When you factor in that, does that change?
I think that companies are using AI as a nice excuse to lay people off. So Block certainly was way behind the 8 ball in terms of right-sizing its labor force. And so they used the excuse of AI, but really they had done overhiring right after COVID when so many companies hoarded employees. And I think you're seeing more of that. So with respect to what Meta said, Meta's had, I remember touring Meta in 2009, and they had a lot of employees at the time. I think they had 3,000, 4,000, but they've been fat around the edges, and I'm sure this is also right sizing for them. So I'm not so concerned. I'll give you an example. So in 2000, when e-commerce and Amazon was getting started and moving beyond books, you had about 15.5 million retail jobs. And today you've got about 15 million retail jobs. And imagine all of the stores that have gone out of business. You have major employers like Sears and Kmart and JCPenney and Blockbuster and Circuit City. And so if that's precedent for what happens to jobs, I take a lot of comfort in that, because jobs will shift. But you still have over 15 million customer-facing retail employees, and that's when over 16% of all retail is done online. So things change, things shift, but I don't think you're going to see a jobs apocalypse the way the dystopian scaremongers suggest. I just don't see it.
All right. So, Meredith, what do you see as the drivers and or the headwinds for the American economy for the rest of the year?
For the rest of the year, my biggest concern is the midterm elections, because that is going to put a lot of stress on the system. So beyond rates, beyond the war in Iran, I think you're going to see 60% of households that are worse off than they were 2 years ago, and they're going to vote accordingly. And I think that's going to put a lot of uncertainty and chaos into the marketplace, by either with voting questions, or just uncertainty in terms of getting anything done, or maybe repealing some of the good things that have been done under this administration. So that's my biggest concern.
Meredith Whitney, good of you to join us. Thanks for sharing some of your time. Appreciate it.
Thank you.
Coming up next, after putting aside the concept of splitting, Kraft Heinz is betting on healthier products to reignite some growth. More in a moment.
Lured by lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them.
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Kraft Heinz is giving some of its biggest brands a healthy makeover. The company's rolling out some new products, including a high-protein Kraft mac and cheese. Let's go to Bloomberg's food reporter, Christina Peterson. She joins us now to talk some more about this. Christina, our Kraft Heinz was initially supposed to split. They have a new CEO, and now it's not going to, but it is going to revamp products. So tell us a bit more about what the plan is.
Yeah, that's right. The new CEO last month decided to halt work on the split and instead reinvest about $600 million in Kraft Heinz. They are rolling out some new products, which they announced today. And the goal is to really get growth going again in the company. And then in a year, at some point, maybe they look at the decision of whether to split anew. He said that's not coming anytime soon, and that the goal is to have the company in a better place when they evaluate to decide whether or not that would make sense.
Okay. I remember a number of years ago when they rolled out a cauliflower mac and cheese. It wasn't very good. But how likely is the strategy they have now to work?
Well, one thing that these big food companies know is that the healthier products only become a hit when they taste good. So when I spoke with the CEO, Steve Kaling, he said that this new protein mac and cheese does taste good. I haven't tried it yet. So the goal is to deliver protein and fiber while still tasting appealing to families, to kids. So they know that this stuff only works if people like the taste.
All right. What else are they doing to try and turn things around here?
Yeah, so the new products that they announced today are in 3 of the brands that have been lagging but have responded well to recent investments. So you have the higher protein Kraft macaroni and cheese. You have a new snack size version of Lunchables. This includes crackers and cheese, but not meat. And then there is a lower sugar Capri Sun hydration beverage, sort of for sports. It has electrolytes in it. And both the new Lunchables and Capri Sun products are aimed at expanding their use beyond little kids, to a teenager or someone who wants a snack at the office. So the goal is to stretch these brands beyond sort of the more common kid usage.
All right. So they own a lot of other brands as well. Have they suggested any plans to revamp there, or is this their focus right now on the handful you mentioned?
Yeah, so I would say that they do have plans to expand some of their better performing brands like Heinz ketchup, Philadelphia cream cheese. They haven't detailed all of those plans yet, but they are in the works. There are a handful of other brands that have not been doing as well, like Oscar Mayer Meats and Maxwell House Coffee, and they haven't really told us a lot about what they plan to do with them beyond generally keeping their market share. I asked about whether selling them might be a possibility, and they said they don't have any plans at the moment, but they wouldn't rule that out. So I think we're seeing some action right now on the more sluggish brands that have some signs of life. And we'll see more on the well-performing brands, and we don't really know yet what's happening sort of at the bottom.
All right, Christina Peterson, appreciate the update. Thank you.
Thank you.
Coming up next, a preview of the Bank of Canada rate decision that comes down tomorrow. They have to factor in, of course, the rising price of oil. Back in a moment. My next guest believes it's too soon for the Bank of Canada to really assess the impact of the oil shock we are seeing as a result of the conflict in the Middle East. And the bank is going to downplay the significance at tomorrow's policy meeting. Let's go to Vinayak Seshasai, Executive Vice President and Portfolio Manager at PIMCO. Thanks for joining us today.
Thank you for having me.
The balance will have to be between the weaker jobs report we just saw and also a tame inflation report that just came out. So how do you balance that right now without the oil shock?
Well, I think the information that we've got so far tells us that the current policy rate actually was very appropriate for the Canadian economy. All the information that we've seen for January and February really suggests that we still have an economy that is struggling to find its feet. The job market is quite slow. And inflation is very well anchored to target. You've got disinflation from rents, you've got disinflation from shelter. So I think ahead of this conflict, at least the Bank of Canada should have been very comfortable that their policy setting was at the right rate. Now, with regards to the oil price shock that we've seen itself, we think it's actually very premature for the Bank of Canada to try and gauge as to what this means for inflation, the economy, and other things. Remember, tomorrow is a non-NPR meeting, which means you'll only have a statement, not a forecast. So it's very likely the Bank of Canada will downplay this. They will cite it as a risk, but it's most likely that they will downplay this and focus more on some of the other information that we've had, like the labor market and the inflation report.
Okay, so when do you think it would be that the price of oil or the oil shock becomes more of a concern for the Bank of Canada? Right now, it's only been, under 3 weeks. But at what point would you start counting it as something that needs to be looked at more in depth by the Bank of Canada?
Yeah, so I think if these current prices that we're seeing today, they persist for another month, I think certainly you would see a section in the April monetary policy report that focuses on simulating what the oil price impact will be to the economy. We will also have some more information about the labor market by then. And even then, we still think that, first half of the year is too early for the Bank of Canada to actually respond through monetary policy to this. Even though you might see a more detailed analysis on what it means for their thinking in April, we really think it's much more likely that this is a second half story. If the oil price persists for multiple months and you've started to see the impact on headline inflation, only then will the Bank of Canada, in our view, consider tightening policy in the second half. And even that will only happen if several other things fall into place. So, for instance, you want to see the labor market, create some jobs. You don't want to see a climbing unemployment rate. We want to see maybe a little bit more certainty that the Kuzma issue will be resolved and we will have continuation of free trade. So, best guess, if this shock persists for another 3 to 4 months, we're thinking it's more of a second half story for the Bank of Canada to actually respond to this.
Because the Kuzma review has been on the schedule for so long, I'm wondering whether you think that's already been factored in and what it would take for that to change.
We do think it's more or less been factored in. At least markets are pricing it to a large extent. Our base case on this does remain that we will have an extension of the deal. In other words, because of multiple reasons, we do think that exiting the Kuzma agreement is not very well favored by at least the Senate and Republicans. And you got to remember, there's a midterm election coming up in the U.S. this November. So we do think that the voices of the Senate and the House might prevail on that one. So our base case remains that we will have, a continuation of the current state of trade, which means that most sectors there will still be free trade. So we do think that on the trade, that has become a little bit more of a secondary issue for the moment, at least in the base case, and while the oil price becomes the more primary issue.
Can you weigh in on the housing market as well? We had new numbers from Korea. They're talking about the fact that both prices are down, activity was down in February. This has been a long-running problem. Buyers are still sort of not jumping in, and part of the conversation is that the rate is just not where they want it to be for them to be jumping off and buying a home. What is your take on what needs to happen for this market to pick up?
Well, I think the housing market, at least when you look at Canada, I think it's a tale of two different stories. On the one hand, you've got Ontario, particularly Toronto, where you've got a big condo market that remains in pretty bad shape. And there does remain a lot of oversupply in the single-family housing market as well. Some other parts of the country are not doing that bad. Unfortunately, we think that this is going to be a much more drawn-out process. There is a lot of inventory that needs to clear. There are a lot of partially built condos that need to be cleared. And we think that ultimately we may need to see some sort of a policy effort to actually set the housing market on better ground if we don't see a more organic resolution over the next several months. But we do think this is not something that is likely to be resolved over the next few months. And we also don't think that interest rates can fix this.
All right, Vinayak, good to have you on the show. Thanks for joining us today. Appreciate it. Coming up, Hot Picks, we will zero in on 3 plays in the semiconductor space. Back in a moment. Time now for Hot Picks, and we are zeroing in on 3 plays in the semiconductor sector. We were joined by Matt Bryson, who's Managing Director covering semiconductor and hardware research at Wedbush, and kick things off with NVIDIA, a stock he thinks is still undervalued.
It's trading at less than 20 times my 2027 fiscal 28 estimates, and they're growing at, I think, 60% this year in terms of top line. So I think they are still the leader in AI. I think AI is changing the world, and I just don't think there's anything that's going to stop them the next couple of years.
So some big announcements coming out today from the CEO of NVIDIA, or yesterday, I should say. Do you think all this spending that we're seeing from the hyperscalers, including NVIDIA, you're not worried about investors being a little concerned about that excessive spending?
Oh, I think certainly that's one of the concerns that's weighing on the stock. I think that there are some concerns around competition, but when you look at what's happening at their customers and you listen to what they're saying, where they're telling you they're not demand constrained at this point. They are supply constrained. You talk to some of their peers and they have the same problem. It's you can't get enough wafer starts at TSM. You can't get enough memory from the memory players. That's actually holding back revenue as opposed to end demand. And from a supply chain perspective, that's how things look through 2027. So it feels like the smartest guys out there, the Microsofts, the Googles of the world, are continuing to lift their spend. And I think the smartest guys are telling you that they're betting more on AI, that we're not going to see spending fall off anytime soon.
Do you think there's a timeline, though, in terms of seeing return on investment for investors, like in terms of investors' patience wearing out?
I think that you have to show an ROI, but at the same time, if AI is going to change the world, and to some extent, we were not necessarily seeing that last year, right? It was still, last year was all about training models for most of the year until you got to the end of 25, and all of a sudden inference workloads started taking off. And if you're effectively doing the job of what used to be humans, you're creating value. And so I think we're finally seeing value creation show up.
Okay, we'll move on to your next hot pick. This one's Micron Technology. What is it you like about Micron?
So memory is really, really tight. It comes back to how much is getting spent on AI. You need a lot of DRAM to support these data center build-outs. You need a lot of storage to support these AI workloads, and there just is not enough capital. There isn't enough production right now, and so we're seeing unprecedented increases in memory pricing. And when you look at Micron, I don't think those price increases are fully baked into estimates. And so you have a company that's is trading at roughly 5 times my out-year numbers. And if anything, I think my numbers are too conservative given what we're seeing in price shifts in the calendar Q1, calendar Q2 timeframe.
Okay, last pick is Everpure. What do you like about Everpure?
Yeah, so Everpure, they make a storage system. They're dealing with the same problem that all the OEMs are. Costs are going up. The thing that they've figured out how to, or the way that their system works, they simply use less memory than everyone else. So they're using 20 to 30% less NAND per usable block of storage than all of their peers. So when everyone's costs go up, theirs go up less. At the same time, everyone on the storage array side is raising pricing. So you have system prices already having lifted 20 to 30%. If we're going to see prices lift again, and I think we are, it becomes really easy to hit growth numbers that are in the teens when your pricing is going to go up that much.
It's interesting they have such an advantage over their competitors, as you just mentioned. Like, where does that
It's
come
just
from?
the way that, yeah, it's just the way they structured their system initially. They've always had higher gross margins than the rest of the industry, and it's always been an advantage for them. It's just we haven't seen this type of cost acceleration before, so they haven't been able to take advantage of it in the way that I think they're going to take advantage of it this year.
Matt Bryson, Managing Director covering semiconductor and hardware research at Wedbush. Data from Statistics Canada shows alcohol sales have been slowing. St. Patrick's Day today will stand to test restaurants as broader shifts towards drinking less start to weigh on alcohol sales. We were joined today by Kelly Higginson on this, president of Restaurant Brands.
The decline over the last 4 years. And what I would say with that is that it's happening at the same time as we've seen a dramatic increase in our input costs over the last 5 years. So we've continually see a drop. At this point, we've got 21.1% of total revenues in 2013 were related to alcohol sales, but that number has dropped down to 17.1 in 2023, which is the latest available data. So that's a pretty considerable drop in the last, 3 to 4 years. I think, we're seeing it per person at table service restaurants, a decline from $1,100 per person in 2019 to about $1,000 in 2025 when adjusted for population growth and inflation.
Kelly, you've given us the percentage of alcohol, but in terms of, can you just narrow it down to sort of a per revenue, like a per customer amount? And then also, if you would, what's the next highest margin item on a typical restaurant? Because I know alcohol is the highest margin, but what's the next sort of step and what can they promote?
So this is where we've got the challenges of sure the spending at table service restaurants. It declined from $1,170 per person in 2019 to $1,050 in 2025. So that is a pretty significant drop. And as to your point, what we've also seen is our, highest cost part is really in food costs and our margins in food costs. So, when we look at the increase in the cost of food over the last number of years, and that's really challenging our operators, the categories in order to find profit has become less and less available to our operators.
And this drop, is it solely by price because of cost? People just don't have the money to spend on that, or is it also they're just not drinking as much? And is it across the board, like from a smaller restaurant up to the high-end restaurants?
So it's a real mix. To your point, we've got 74% of Gen X who are stating that they're reducing alcohol for health and wellness concerns. But 44% of Generation Z are reducing alcohol because they are trying to save money. And the millennials right there in the middle with 51% are reducing alcohol for social and lifestyle cost reasons. So, we've definitely got a mix of all the reasons there. But, the reality is we've got a younger portion of Canadians aged 18 to 22 reported not drinking any alcoholic beverages in the past 7 days, which is a real switch compared to 54% for Canadians overall. So that next generation of consumers are drinking considerably less.
Wow.
Kelly, do you think there's any chance of stabilization here? I always get the situation that maybe one of the parts, and you mentioned it, is cyclical, but in terms of sort of getting down to a level where restaurants can actually sort of say, okay, that's the bottom, is there any chance of that?
I think we're actually, and look, I mean, this is all a guess, but to your point, I think we often see the pendulum swing in directions as far as trends. And, obviously we do have a chronic affordability issue, which that doesn't seem to be going away. But as far as kind of the lifestyle trends, we tend to see those pendulums swing pretty rapidly. And I do see it maybe starting to come back a little bit. But I also think as we talk to operators that we have to meet the consumer where they're at. So let's look at different ways that we might be able to. Is it serving lower alcohol level drinks? So some people are talking about still enjoying cocktails, but they're doing it maybe once a week. They're doing it less often, and they'll spend a little bit more for something that's higher quality but lower alcohol levels. Can we look at more operators? There was a period where we were increasing our ounces and glasses of wine up to 8 and 9 ounces for the large size. Maybe we need to look at having more serving those 3 and 4 ounces, something to sip on while you're having your actual meal. Those are going to be areas that we're going to have to explore. And I think there's definitely a lot of room for operators to explore the non-alcoholic beverage category. There's a lot of different ways we can have exciting cocktails that have no alcohol in them, but there's also some great products coming out on the market, beer, wine, and lower alcohol and no alcohol spirits.
And I think that may be challenging with the price too, because I've gone to restaurants and they have those mocktails. I know they don't call them mocktails anymore, but I mean, some of them are almost the same price or not much lower than a drink with alcohol in it. And I think you look and go, well, that's a lot of money to spend just for something that doesn't have alcohol in it. I just want to go back to, I mentioned about, is it across the board when it comes to restaurants, high end, low end? Is there a bit of a K-shape with the restaurants like we're seeing in the economy where the higher end people are still spending on alcohol and higher end alcohol, whereas when you get down to the lower end, they're holding back?
Yes, I mean, where we've seen the biggest drop really is in the category of bars and nightclubs. They've seen the biggest drop over the last number of years. And again, this goes to when you're talking about the higher end. Definitely, we're still seeing the purchases, but we're seeing they're spending more on a higher quality of a bottle of wine as opposed to the volume of wine. So this goes to really consumers looking for that experience, and they'll spend a little bit extra to have a really good cocktail as opposed to having maybe 3 mediocre cocktails. And then again, with the wine and other specialty items.
All right, and we're out of time. I just want to ask one more question. It's St. Patrick's Day. What are we expecting for today?
You know what? I'm cautiously optimistic, but I think, if I think back to the days of the lineups starting outside of some of our favorite Irish pubs early in the morning for people to get a seat, I think it's fair to say that those days have come and gone. So, hopefully we see people get out and enjoy their local restaurants, because it's definitely a challenging period for all of us.
Kelly Higginson is president of Restaurant Brands. That does it for The Close today. Thanks for joining us. We'll see you tomorrow.